In recent days, while global gold prices have dropped, prices in China have continued to climb. Many gold shops across the country have reportedly closed, and some are refusing to buy back gold from customers. Analysts say China's gold market is showing clear signs of decline.
带大家来看看今天的
Online
水贝。
videos show the once busy Shuibei gold market in Shenzhen now nearly empty. Other footage reveals several jewelry stores along one commercial street closed, sparking speculation that soaring prices have forced shops' owners to leave. On November 1st, Chinese authorities suddenly announced the end of a certain tax break for the gold industry. The change reduces input tax deductions for non-investment gold businesses, raising production cost by more than 60 yuan per gram, equivalent to about $8 per gram. The policy will stay in effect until December 31st, 2027. The announcement caused an immediate market reaction. Hong Kong's gold and jewelry stocks fell sharply, and trading in gold jewelry nearly stopped. Many retailers suspended shipments as uncertainty grew.
If gold prices keep going up this ridiculously, a lot of jewelry shops are going to go out of business. The next step will be massive layoffs across our whole industry. Last year, when gold was just over 500 yuan per gram, people getting married or those with real needs could still manage to buy a little. Now, no one's buying at all. The branded gold stores have already doubled their prices. With prices this high, regular folks simply can't afford it, and they're too scared to buy anyway. Sales have basically frozen. If prices keep rising like this, it won't be long before no one's even doing gold recycling anymore.
On November 3rd, Hong Kong's gold and jewelry sector fell again following the tax change. Chow Fook shares dropped as much as 12%, while Chow Shanshan dropped over 8% and Laopu Gold fell over 9%. In mainland China, A-shares retail jewelry stocks also declined, with CHJ Industry down 9.9% and Chow Tai-shen and Lao Fenxiang losing over 3%. According to a November 1st report from the Ministry of Finance and the State Administration of Taxation, gold traded on the Shanghai Gold Exchange and Shanghai Futures Exchange will remain exempt from VAT while kept in storage. However, once physically delivered, different tax treatments will apply depending on whether the gold is used for investment or consumption. Under the new rules, stored gold is tax-free. Investment gold will be taxed first and then refunded later, but subsequent sales will still be taxed. Consumer gold will be exempt from VAT but allowed only a 6% input tax deduction, down from 13%. Analysts say this shows Beijing is now separating investment gold from consumer gold. Citigroup analysts cited by Bloomberg estimate that the new policy will raise gold procurement cost by about 7%. Retailers may increase prices to cover the added tax burden. If they are unable to pass on the cost, leading brands like Laopu Gold and Chow Tai Fook could see profits fall by 15% to 26% in fiscal 2026. In fact, the new gold tax policy has already pushed up physical gold prices in Shenzhen's Shuibei market. Rising uncertainty has led many retailers to slow sales, while gold recyclers have become more cautious. Media reports indicate that gold prices in Shenzhen Shuibei jewelry market rose from 931 yuan per gram, equivalent to about $131 per gram, on November 1st to 991 yuan, equivalent to about $139 per gram, on November 4th. In Beijing's Tianya jewelry market known as Beijing Shuibei, jewelry gold reached 1,066 yuan per gram on November 3rd. 142 yuan above the market rate. Chow Tai Fook's prices also rose from 1,198 yuan per gram on November 1st to 1,259 yuan per gram on November 3rd, followed by 1,265 yuan per gram on November 4th. A sales representative told Chinese media that the increases reflect higher material cost and taxes. The salesperson said customers are losing interest in buying gold. The gap between buying and selling prices are now at least 70 yuan per gram, equivalent to about $9 per gram. Another salesperson said the price increase has made the market highly cautious, with most stores now reluctant to sell. Analysts expect the new tax policy to further weaken retail sales and curb demand for investment-grade gold bars. The wave of store closures is likely to intensify. As a gap between selling and buyback prices widen, gold's value as a hedge against inflation is fading. With prices now above 1,000 yuan per gram, e-commerce platforms face tighter margins as they try to stay competitive. Combined with the new tax rules, this may push smaller players out of the market, favoring large, well-funded platforms. Reports from the paper and GMN News show Chow Fook has begun scaling back its expansion. After growing from 4,000 stores in 2021 to more than 7,000 in 2024, it closed over 900 stores in 2025, marking a major strategic shift. Other jewelry brands are facing similar troubles. As of September 30th, Chow operated just over 4,600 retail stores, a net drop of 560 from a year earlier, and more than 300 fewer at the start of this year. Most of these closures were franchise stores, with about 380 outlets shutting down. During the first half of 2025, Chow Group saw a net reduction of 74 stores in mainland China, including 62 closures of its flagship Chow brand. Zhou Liufu also cut 280 franchise outlets during the same period. This wave of closures show a clear pattern, both in geography and business model. Data from Chow Fook indicate most withdrawals happened in third and fourth tier cities, mainly among franchisees. Chow Taishan's half-year report confirms this. Stores in lower tier cities fell by 441 year-on-year, the steepest decline so far. At first glance, you might think rising gold prices would boost jewelry retailers, but in reality, it's quite the opposite. According to the World Gold Council, gold jewelry demand has dropped sharply since late last year. Meanwhile, investment demand for gold ETFs and similar products has jumped from 18.7 tons to 221.7 tons, showing that today's gold market is driven by investors, not jewelry buyers. High gold prices are putting huge pressures on franchise owners. They're unwilling and unable to stock up at these levels. It ties up too much capital and risks big losses if prices fall. Chow Taishan's data reflect the strain. From January to September 2025, franchise revenue plunged 56% year-on-year. In its latest report, Chow Taishan said persistently high prices are suppressing jewelry consumption. Consumers are becoming more rational and cautious, delaying non-essential purchases. With gold now hovering around 1,200 yuan per gram, equivalent to about $169 per gram, many people are waiting for prices to drop or turning to alternative products. Even newlyweds buying wedding jewelry are choosing smaller, lighter pieces or compromising on brands and craftsmanship to stay within budget. On top of that, China's new gold tax policy and recent price swings have driven shoppers away from stores. In the Shanghai market, funds in gold futures saw mass withdrawals, with 7 billion yuan equivalent to about $980 million in outflows over just 2 days. Meanwhile, bearish comments from central bank officials in some countries have also raised concerns that gold prices may have peaked. By late October, international gold prices dropped sharply, casting uncertainty over China's gold market. In the Shanghai gold market, both spot and futures gold fell about 10% from their highs. According to Chai Lian Press, after Shanghai's spot gold broke 1,000 yuan per gram on October 17, it plunged below 900 yuan by October 28. Gold futures also saw net outflows of 5.5 billion yuan that same day. Analysts believe the market now lacks strong drivers and face technical downward pressure. Volatility is likely to continue as investors adjust to the new reality. Meanwhile, business at Shanghai's Zhijingchen Jewelry Trading Center, also known as the Shanghai Shuibei Market, has taken a heavy hit. Chinese media report that the 6-story complex houses major brands like Lao Fengxiang and Chow Fook on the first floor, while smaller Shuibei-style stores fill the upper levels. But at midday on October 29, both brand counters and small shops were deserted, a stark contrast to the bustling crowds seen in better times. One jewelry store owner told local media that while price swings don't hurt small gold pieces much, they seriously impact larger sales. The owner said, "If I bought stock a few days ago and sell it now, that's fine. But if I don't sell, I'm already losing money today. Gold margins are razor thin. We rely on volume to survive." An industry veteran pointed out that China's new gold tax was designed to keep gold prices from falling and discourage speculative investment. Between 2021 and 2024, retailers like Chow Fook expanded rapidly across mainland China, betting that the economic slowdown would erode other asset values. Back then, gold hovered around 500 yuan per gram, equivalent to about $70 per gram, offering both practical and investment appeal, which fueled strong sales. But this year, China's economic woes deepened. The collapse of the property sector, shrinking household incomes, and surging gold prices have put immense pressure on traditional gold retailers, who depend mostly on processing fees, not gold sales themselves. Adding to the pressure, China's banking sector is struggling with losses and a widening fiscal gap. The central bank has cut interest rates to ease deposit burdens, but it also fears people might shift savings into gold, destabilizing the financial system. Authorities have therefore signaled they'll limit gold investment demand. For similar retailers like Chow Tai Fook's mainland branches, which lack deep financial backing, handling investment grade gold bars or ingots isn't feasible. Their only option has been to shrink operations and close stores. A customer filed a complaint against China Gold, saying she was refused when trying to sell back gold bars at the store. One online user commented, "China Gold is the worst. Never buy gold there. If they say they won't buy back, make sure you test if it's real." Recently, several users on Chinese TikTok Douyin uploaded videos claiming that China Gold sold fake gold, urging others to have their purchases tested. Some users shared receipts and testing reports saying that hollow bracelet bought from the retailers were counterfeit. Industry insiders say gold counterfeiting and adulteration have long been common in mainland China. State-owned companies such as China Gold are often the easiest places for consumers to be misled. Many people believe state-backed firms are the most trustworthy, but that may not always be true. Because they have powerful backing, these companies face little consequences when they commit fraud. In contrast, Hong Kong-based chains like Chow Tai Fook and Chow Shan Shan are generally viewed as safer because they operate under stricter business standards. However, these brands are now scaling back their operations on the mainland. This trend is troubling for mainland consumers. Even the Industrial and Commercial Bank of China, or ICBC, nicknamed online as the universe's first bank, recently faced serious issues. Starting on the evening of October 29, many ICBC users reported that after logging into the mobile app, their assets and wealth management products showed incorrect balances, with some even appearing to be zeroed out. The problem continued into the next day, sparking wide discussion online. One customer described the shock. "I opened the app to pay my credit card last night and my total assets showed zero. All my funds, investments, and products were gone. It really scared me." Other customers also saw discrepancies in their gold holdings, in some cases showing losses of up to 10%. Screenshots shared online showed more than missing asset data. Some users also found their credit card information gone, with entire sections for bank cards, loans, and investments displaying no data available. A Beijing resident, Miss Zhang, said that when she checked her salary late at night, her account balance had vanished. Her first thought was that she was a victim of telecom fraud. She repeatedly tried to contact ICBC customer service overnight but couldn't get through due to the surge in calls. The phrase ICBC assets zeroed quickly became a trending topic on social media. On October 30th, ICBC confirmed through the media that its mobile banking system had suffered a temporary failure. The bank said the issue caused inaccurate displays of assets and liabilities on both mobile and online platforms, but stressed that customers' actual funds were safe. According to mainland media, apps display began returning to normal by 4 p.m. on October 30th. However, some users still reported problems after that evening, saying their accounts continued to show incorrect data. Although no money was lost, the incident raised public concern about the reliability of the banking system. ICBC, which serves 588 million mobile banking users, is seen as a benchmark in the industry. In 2024, it spent 28.52 billion yuan on financial technology and employed 36,000 fintech staff. Its two cities, three centers disaster recovery system is the first in China to earn Data Capacity Maturity Model DCMM Level 5 recertification. With such advanced resources, analysts question how a front-end display error could affect so many users. Some analysts believe the authorities may have treated the ICBC glitch as a stress test. With growing pressures on banks, even the central bank's large-scale money printing might not stabilize the system. The government could, in theory, use measures similar to those seen in North Korea or Venezuela, such as currency reforms that wipe out the public's bank deposits. Such large-scale actions might test both the financial system and public reaction. In the meantime, authorities may try to stop citizens from moving their money into gold or foreign assets to prevent bank runs amid shrinking liquidity. For those unable to leave the mainland, options are limited. One possible hedge is to convert as much yuan as possible into US dollars and keep it in cash as a safeguard against uncertainty.